All right, so what is private equity banking? And this is Eric's definition. It's a partnership between private individuals, so you and I as individuals, with private, in other words, non-publicly traded, cooperative financial institutions. I know that's a mouthful right there. To combine the private equity of like-minded individuals for banking and wealth preservation. Now, that definition might not make sense right now. Fine. I'm going to try to make it make sense before this is all over with. So private equity banking, it's often used to do some of these things. Eliminate debt, like Mike said, well, let's first get people out of debt. And then you can use it to finance your current lifestyle. And that's what Mike was talking about during that little video there, is he was saying, I want to use it so I can acquire other things. And that's what it's talking about there, is to finance our current lifestyle. I'm going to talk a lot about that today. Create wealth, protect existing assets, build generational wealth, and do all of that simultaneously. So if I were to put it into a nutshell, the goal of private equity banking is to give us back control of our private financial condition. So let me begin by asking this question. How much of your financial security depends on people and companies and economic situations that you can neither predict nor control?
100%.
Okay, Owen, that's 100%. How about you, Michael? How much of your financial security depends on others?
Oh yeah, I'm with Owen.
You're with
100%.
Owen, okay. Juliana, how about you?
I'd say about 50-50.
Okay, good. Again, I don't know that there's a right answer for this. Each of us is in a different position, right? But here's the thing. Most of us fail to realize that we have the power to control our financial landscape. Now, I know you're thinking, what on earth is he showing a picture of the Wizard of Oz for? Did you guys know that the subplot to that movie was about taking back our private control of our financial condition? Had anybody ever heard that theory before?
No.
No.
Nope.
Well, it was. Here's the historical background. In 1873, the United States passed a law. It was called the Coinage Act, which eliminated silver dollar coinage. And so the yellow brick road represented the gold standard that they were forcing upon the American people. At least that's what the poor class, the middle and poorer class of America felt. They felt that by getting a gold standard, this favored bankers and industrialists, making it harder for them to repay their loans in gold. Oz, the city of Oz, stood for an ounce of gold. And by the way, in the book, not the movie, she wore silver slippers, and those stood for the silver coinage. And then Dorothy represented those of us naive Americans looking for financial solutions. The Scarecrow was the farmers. The Tin Man was the steel industry. The Cowardly Lion was our military. The Wizard of Oz were the scheming politicians. And Emerald City was New York's bankers and Wall Street. And then the Wicked Witch of the East was the Eastern banking establishment. Now, that was back in 1873. I know today we've moved along in this world a long ways, right? We don't have to worry about bankers and politicians taking advantage of the naive Dorothys anymore. Is that correct?
In some cases.
In some cases, Michael's got a smile on his face like, yeah, right.
Don't you remember Wells Fargo?
Yeah, exactly. So 2008, the presidential debates, these two senators were asked the same question. Will you vote for the bank bailout? Now, usually when it's blue against red, we get two separate options. If one says no, the other says yes. And if one says yes, the other says no. But in this case, both of these senators said, yes, but, and then they changed the topic. I don't know if any of you have ever seen this movie. I just want to play parts of the trailer. It's called Inside Job. This will take us back to 2008.
Share prices continued to tumble.
Lehman Brothers was forced to declare itself bankrupt.
The largest single point drop.
The regulators, they had the power to do every case that I made when I was state attorney general. They just didn't want to.
We are watching this tsunami coming.
They were having massive private gains at public loss.
It's a Wall Street government.
Why do you think there isn't a more systematic investigation being undertaken?
Because then you'll find the culprits.
I don't believe I have to discuss that with you.
come to us today telling us we're sorry, we won't do it again. Trust us. Well, I have some people in my constituency that actually robbed some of your banks. And they say the same thing.
I never heard him mention those things.
Could we turn this off for a second?
So we now know, I mean, by the way, the only reason I'm working is because I lost everything I had in 2008. I had 16 rental properties, and that was my retirement plan, and we lost it during 2008. I won't whine. A lot of people did. They lost a lot in that time. But at the time, Janet Yellen, she was brought in 2013 as the chief of the Federal Reserve. And when she came in, she defended in front of Congress the $13 trillion stimulus that we had just given to the banks. And then in 2017, Ms. Yellen said, I don't believe we'll see another financial crisis in our lifetime. Anybody want to bet me a Coke and a Snickers bar that ain't true? Yeah. Juliana's shaking her head no. Owen's chuckling. Okay. Now she's done that revolving door thing and gone from the private sector to the government side, and she's now the Secretary of Treasury. So I went out there under her watch, and I'm not trying to pick on her. I could have done this for almost anybody, but in this year, Citizens Bank went down in November of this year. Heartland Bank went down in July. First Republic bankrupt in May. Signature Bank bankrupt in March, and we all heard about Silicon Valley Bank going out. Now, that was the big famous one. Now, I want to ask a simple question, and I don't mean it to be condescending. I just want to make a point. Back during the Great Depression, when there was a run on the banks, what did people have to do to go get their money out of a bank?
Wait in line.
Get in line, yep. And on March 9th, that was a Friday, so on March 8th, the Thursday before Silicon Valley Bank went down, do you know how many tweets went out about that bank out of all the tweets that got sent that day?
None.
Less than 10. Yeah, there was about 8. Do you know how many went out on the day of March 9th? About 8 million. Here's what happened. Founders Fund, which was a venture capitalist in San Francisco, they told some of their portfolio companies that they didn't believe that SVB was solvent and they should probably pull their money out. Now, how long does a story like that take to get around San Francisco Bay Area?
Wildfire.
Yeah, like wildfire. And 8 million tweets went out in about 4 hours, and customers withdrew $42 billion, 20% of all of their withholdings in just 4 hours.
They were lucky they got their money.
That's right. Yeah. So what we're trying to do is show people how to get financial control. And I believe that when we do take back financial control of our own lives, it is the most lucrative endeavor we can pursue throughout our life and for generations to come. Pretty bold statement. I want to show you how. How? One, as I said earlier, eliminating debt, financing our current lifestyle, building a tax-free wealth, and doing all of that simultaneously. Now, we all have our job, and I've got this depicted as loan officer with the little computer there. We could be a doctor, a school teacher, it doesn't matter. When I found out about this, I was a Marine. This was many years ago. And I was reading this book called Multiple Streams of Income, and I thought, I need to have a side gig. And if I'm going to have a side gig, why not turn it into banking? So why would I want banking? I wanted to have my own private bank, which is why I named the company Private Equity Banking. In fact, I want to put my own name on it, but I just kept it Private Equity Banking. So why banking? Well, banking, as we know, is the strongest force in our economy. Without loans, everything falls apart. That's what we do for a living, right? Banks control the money supply. Banks control if we qualify for a loan. Banks control how much we pay for student loans, for credit cards, for cars, and for mortgages. And so it's all about controlling this money. What I want to be able to show you, as Mike said, can help you in your own individual lives, but I think it can also help your clients. Because if you could help your clients eliminate their debt, how many of them could get a bigger, better mortgage?
Mm-hmm.
So that's one of the ideas here, right? So again, why banking? Huge profits. Now, we know this as loan officers, so I know I'm talking to loan officers, and so I kind of threw this in here because of it, because we do know this stuff. But what do banks really make on a 7.5% mortgage? So on a $300,000 mortgage that you just got for somebody at 7.5, and I know rates have been going down, yay! But over 30 years, at 12 payments a month, what we're looking at here is P&I of $2,098 a month. And principal of that $2,098, only $223 of that goes to principal. The rest of it goes to interest. And so here's this term called volume of interest, which basically says 89% of that person's first payment is going to go toward interest. So for every $1,000 that you put somebody into a loan on right then, $894 of that is just paying for interest. And if we take that out to the end of the first year, now they've paid in at $2,000 a month, $2,100 a month. They've now put in a total of $2,766 toward principal, and $22,000 of it has gone toward interest. Again, volume of interest is 88%. And this is what kills us. Even out at year 7, having put in, again, 7 years worth of payments, only $24,000 of that has gone toward principal. $151,000 has gone toward interest. And we're still at a volume of interest of 82%. Look at that. I mean, think about that. After 7 years, the balance has only gone from 300,000 down to 275. It's a pretty wealthy endeavor, right? So it's leverage. Now, how do banks get leverage? We all, I believe, know what Tier 1 capital is, correct? This is what the banks have to, okay, so Tier 1 capital is the money that banks have to have in their coffers so that they can make loans. And then what they call this is a loan risk to capital ratio. What this is saying is that the banks collectively have $2.1 trillion in capital in reserves, and they've lent out $14.5 trillion in capital. So they make a whole lot of money. So it's only about 14%. So on a $300,000 loan with their cap ratio at 14%, that means a bank only had to have $42,000 sitting in it. So think about UWM. We go to UWM, we get a loan for $300,000. How much do UWM actually have to have in their coffers to make a $300,000 loan? About $42,000. Exactly. So if you look on the cash on cash return, $42,000 is how much they've got, and over 7 years they're going to bring in $176,000, right? So that means they made a profit of $134,000 on $42,000. The ROI on that, 319%. Where can you get that these days? Pretty good, huh?
You got to be UWM.
You got to be UWM. Yeah, exactly. Now you know why he can go buy basketball teams, right? So 24% invested, 76% made. All right. So, wow, I need to be a banker. So let's take this all the way out to year 10, and this is where I want to make some comparisons. So year 10, again, they've made total payments of $251,000. $212 of that's gone to interest. $39,600 of that has gone toward principal after 10 years of payments. You're still at a volume of interest of 77%. Here's my question. If we could change 7.5% and you could borrow all the money that you need for your finances in your life at 0.5%, not 5%, 0.5, 50 basis points, could that help you? Yeah. And that's what we do. So let's look at the difference here. 7.5, I already walked through that, almost $40,000 toward principal. And here at 0.5, look how much has gone toward principal. $242,000 on that same loan. And over here, the amount that's gone toward interest at 7.5% is $212,000 versus $9,034. Which side of that equation would you rather be on, right? So a volume of interest of 77% versus 1.2%. This is why I call this the best side hustle you can have. And here's my concept, and my crazy mind here. Instead of paying $212,000 in interest, if I had my notes at 0.5%, I'd have not wasted $203,000 over 10 years. So 200,000 divided by 10 years, that's about 20 grand a year. And all I had to do is change how I finance my lifestyle. Does that make sense? I didn't have to work an extra hour. Yes, Owen.
I said, yeah, that makes sense.
Yeah. So that's why I call it the side hustle. It's really not a job that you have to go work any hours on. You just have to change how you finance your lifestyle. So, all right. So, would that give you back some of the control of your financial situation if you could borrow at 0.5%?
Yes.
Okay. And what could you do with that extra $20,000 a year? You don't have to answer that here. But, and how would that make you feel? I guess that's probably the better one.
Yeah.
Exactly. So, do you have any clients, loan officers, that would like to be able to change their mortgage that they're currently paying with you to 0.5 point?
Yes.
Yeah. And we're going to teach you how to teach them how to do that. And if you can do that for your clients, do you think you'd be with them for life?
Absolutely.
Yeah. Okay, so here's my dream bank. I want my money when I put it into that bank, after I put it in there, I want it to grow tax-free, and I want to have access to that money tax-free. Everybody cool with that idea? I want liquid cash. In other words, I want access to my money anytime I want. I don't want any age restrictions and no funding caps. Again, this is my dream bank. I want protection from creditors and lawsuits. So if I get in a crazy accident tonight, I don't want somebody being able to come back and, freeze my accounts, right? I also want protection from an unpredictable economy. Where do you find that these days? And I want it protected from bank failures. I want guaranteed rates with zero market risk. I want compounded interest. In other words, my cash value that I put in there, I want that to grow and compounded, and any dividends that I make while the money's sitting in my account, I want that to grow. And then also I want arbitrage. And what I mean by that is I want to be able to use my money twice. And I know that's not a word that we always use, so let me show you the definition. The definition of arbitrage is the simultaneous savings and borrowing of currency in two different accounts to take advantage of different interest rates for the same asset. What I mean by that is this. And by the way, this is sanctioned by the IRS, and the IRS calls it a cash accumulation contract. And that contract is the key word there. And in that contract, it spells out how much interest you're going to make when you put your money into the bank. And it also tells you how much you're going to spend when you try to borrow that money. Okay? So that's my dream bank. In other words, if I deposit $100,000 into this bank, and I want to go borrow $75,000, I don't want to have to take out that money from my account. I want to leave my $100,000 in there as collateral, and I want to borrow the bank's money. Does that make sense?
Well, isn't the bank's money your money?
It is, because it's a collective. And that's why I said back in the very beginning is what it is it's joining everybody's money together so that we can all accomplish something with bigger amounts. But not everybody's going to want to borrow back at the same time, Juliana. But yes, what they don't do is take the money out of your account to give you back yours. They're giving you the money that's in the general fund of the company. And your money stays there. And so what that allows us to do is that I still want to get tax-free compound interest on my $100,000. In other words, if I put money in my 401k, am I allowed to go borrow money out against it? Yes, if you've got emergencies, they'll let you do that. Okay.
What's the penalty?
Exactly. And if I take that 75, let's say I've got 100,000 sitting in my 401k and I want to borrow 75,000, they'll let me go borrow it. But while my 75,000 is out, is that 75,000 still sitting in my mutual fund that's growing?
No.
No. And that's what I'm trying to say is the difference here. My 100,000 is still getting that guaranteed contractual interest rate, even though I go borrow 75,000. So I now have two accounts. Yes, ma'am.
Is that compound interest daily?
Yes, ma'am. Yep, it's just like the CMG loan, if you're familiar with that, all-in-one loan. You familiar with that loan, Juliana?
No, I'm not, but I'm tracking with you.
Okay, well, I'd say write that down. Just put CMG and go talk to the gal that runs that. It's one of our lenders. By the way, and that's why I got into this. I understood the CMG loan, and so when I was given this and understood it, I was like, oh my gosh. It's just like having a HELOC, except I'm not paying interest on the HELOC. I'm getting paid interest on my primary HELOC. But that's
okay. So let me just say something because you said we could jump in.
Yes, please.
Okay, so if I have $100,000 in my 401k, because remember, this is my second time around, so it's making more sense this time. I
It's
have
fine.
$100,000 in my 401k. I take that money out and I put it in the private equity banking account.
Mm-hmm.
And then I want to borrow $10,000, $20,000. I'm still getting credit on the $100,000 that's in the bank.
Yes, ma'am.
And when I pull out that $10,000, I'm pulling it out tax-free.
Yes, ma'am, because you're borrowing it.
I'm borrowing it tax-free,
Yes,
but
ma'am.
my daily compound interest is going to be on the 100,000,
Yep.
even though I've borrowed $10,000.
Yes, ma'am. Yep. And you'll have interest on both of those accounts. So let's add a little bit more complexity to that. Your $100,000 is still growing at 5%, and the amount that it's growing at, let's say, with one of the companies I'm with right now, I can get you where they're paying you 5.2%. And when you borrow, how much do you think you'd have to pay when you borrow from them, more or less than 5.2?
I would say I wouldn't have to pay. I, I don't know.
It's less. It's 5. So loan officers at NEXA, you have 220. We have 220 lenders available to us. Which one of them pays us 20 basis points to take out a signature loan?
None.
None. A very good answer. Yeah. So that's what you can do. That's what I'm talking about here. I'll go more in depth in that in just a second. Yeah. So here's my problem too, though. If I want to be my own bank, I also have to have tier one capital between 20 and $25 million. And last time I checked my bank account, I didn't have that much in there. So I couldn't become my own bank. So I decided, well, I need a partner, right? And here's the definition of tier one capital. It includes liquid items such as common stock, retained earnings, and publicly disclosed reserves. Keep that last part in your head for a second because I'm going to come back to that. So the reason they've got this money there is just in case a bank does begin to go insolvent, they can take that common shares and they can pay off what they need to stay solvent. Then there's tier two capital. They cannot make loans against this part, but this is it includes items such as undisclosed reserves and subordinate debt. So I decided, well, I can't do this on my own. I don't have the 25 million to become my own bank. I'm going to have to get a partner. So I want a partner that's been around for over 100 years with solid profits and zero losses ever. How would that be cool for finding a franchise partner like that? So I went to Bank of America and I went to Wells Fargo's websites and I thought, okay, I'm going to go and see if they fit my criteria. This is a real question that I'd like to ask and I'd love to have an answer to. When you get a commission from NEXA and they put it into Wells Fargo or Bank of America or your local credit union or wherever you bank, who owns that money?
They do.
Yes, Juliana, they do. Did you know that, Owen? Michael?
Didn't know that.
Yeah, they own it. And this has been proven over and over in the courts of law. What we become is legally a bank's creditor. What you're basically doing is becoming a creditor to the bank. Owen, when you deposit your quote unquote money into their bank, you become their creditor. And they can do with that money as they please. In fact, you become a tier two subordinate debt. In other words, their stockholders are above you in the pecking order of who gets paid back first when they start to struggle. All right. If I want to borrow, who decides? Well, there shouldn't be a single loan officer here that doesn't know that answer, the bank. Protection from credit and lawsuits? No. Is my money transferable? Yes, with tax ramifications. Is my cash increase taxable? Yes, I get a 1099 on the measly amount of interest that they pay me. Who determines my interest rate? The bank does. Who determines the repayment schedule? The bank does. My credit score is only 30 days away from becoming bad if I don't make payments on loans. Need collateral? Yes, the bank owns that. We know that. The banks have the collateral on the homes that we get people, and the same thing with cars. If it's a signature loan or a credit card, by the way, our estate still has to make good. Even if I die, they're going to come after my estate. Do extra payments buy me leniency with a bank? No. When a loan is paid back, I'm back to zeros. And I asked, well, do you guys have profit sharing? My wife got so upset with me the other day. We were on with Wells Fargo getting another account. That's who we bank with, from our business standpoint. And I said to the young guy, I said, do you guys do profit sharing for those of us that have been with you for all these years? My wife kind of nudged me like, you jerk, don't be mean to the kid, you know? But of course not. And I asked, do you guys have small franchises for people like me? And they said no. So there's no franchise opportunity with the banks. So then I thought to myself, well, who manages the bank's liquid tier one cash? Again, tier one means they can't put it at risk. Let me repeat that. Tier one money is money the bank has to have in a liquid environment that cannot be put at risk. Does that make sense? In other words, they could think that ABC company is the hottest company on the planet, or this, I don't know, cryptocurrency is going up so much, we better buy some cryptocurrency with our tier one capital. They're not allowed to do that. It has to be available. So I asked myself, well, the banks, they're in the money business, obviously. They've got legions of economists, attorneys, accountants, and data analysts working on this stuff 24 hours a day, 7 days a week with one goal, maximizing economic output. Where do these guys put their money? And then I remembered while I was working on my MBA that we used to be, during our finance classes, in one of them, we went out to the FDIC's website because the balance sheets, we were doing, the financial stuff in the MBA thing, and they were showing us balance sheets. And since publicly traded banks have to put their information out on the FDIC's website, I thought, well, heck, I can go look and see where they put their money because they have to disclose it, right? So I went to the FDIC's website and I looked up Wells Fargo. Would it surprise anybody that they had at the time, that's in thousands of dollars, so they have $8.5 billion worth of real estate. But real estate isn't tier one capital. You can't sell that on the market tomorrow. If they had to get rid of, drudge up cash real fast, they can't sell these buildings overnight, right? So they can't use that as their tier one capital. If you go down a little bit further, on line 41, it says insurance assets. And Wells Fargo has in 2017 to 2018, which is when I looked this up, they had $18 billion. Sorry, let me go back a slide there. Well, I'll just do it with Bank of America too. Same thing. Bank of America has $9 billion in real estate, and they've got $22 billion in life insurance.
Eric, is that mortgaged homes or is that the branch locations and their value?
That's the branch locations and their value. Good question.
Thank you. Yeah.
Yep.
I'm just wrapping my head around all this.
Yep. So they have twice as much money in cash value life insurance as they do on in real estate. How many of you would have ever thought that's where they stick their money?
No.
And they do it because it's super safe. So if
How
you
do they
think
do that?
So they have what's called BOLI, Juliana. It's called BOLI is the name of it, bank-owned life insurance. And so what they do is they go buy these life insurance policies. And by the way, that number that we just saw, the 18 billion and the 22 billion, is cash surrender value. In other words, if they have to give up that policy right now today, because remember, that's the whole point of tier one capital, is if something happens, they've got cash available. That's how much they've got in available. The death benefit on those policies is probably going to be about 5x more. So both of those companies have about $100 billion in death benefit on the books. If you've ever wondered, when they talk about the salaries, remember back in 2008 how we bailed out the banks, and then all of a sudden they talked about how the executives were getting these multi-million dollar, bailout packages to, even though they were failing, and we were paying those things. Well, the reason that they get this is the banks have bought life insurance policies on them, and what they do is they pay those policies until after until way after they're retired, till they keep paying on them until they've died, and then when they die, the death benefit is big enough to pay off all their salary through the entire time they worked for them. So, Michael, you become the CFO at Wells Fargo at age 65, they know you're going to be there another 10 years till you're 75, and then they figure you're going to live till you're 85. So what they do is they buy a death benefit big enough to pay your salary for 10 years and pay you a pension for 10 years and recoup all of their money when you finally do die at age 85, and they get that all back tax free. Now, what if I told you you could do that for your own self?
Can we do that if we own a business for our own employees? If
Yes,
we
you
own a
can.
car wash company? Okay.
Yes, you can. You can do it for your own employees. You can do it for yourself. Yes, you can. Yep.
Do an ice cream shop. Okay, got it.
And you can do it for your kids and your family members.
And that's called a BOLI?
No, okay. You can't get a BOLI because that's bank-owned life insurance. It's a specialty product, but you can get the same concept of it with private equity banking. That's what I can help you do. Yes, absolutely. There's a good book out there if you want to understand Wall Street better. It's called Pirates of Manhattan. And in there, this guy makes a very obvious statement. Money must reside somewhere. And then he says, when viewed in this light, of all the alternatives, permanent cash value life insurance is perhaps the safest and most economically efficient holding tank of cash savings within America today. That's why I just got through showing you that's where the banks put their money. How many of you had ever thought about that?
What is that permanent cash value? Is that term life insurance?
No, ma'am. Term, it is not. It is whole life. If it's term, it is not permanent. Term, just the word term itself, Juliana, means it lasts for a term. Yeah, it lasts for 10-year term. It lasts for a 15-year term. When it's permanent, it lasts your entire life. And what makes the biggest difference for me between those two, Juliana, is that let's say you pay into a permanent cash value insurance policy. Well, let's first do the term. Let's say you buy a 10-year term, and after 5 years, you say, you know what, I don't want this insurance anymore, and you quit paying. What happens to that policy?
It goes away.
It goes away. And how much death benefit do you have?
None.
None. If you have a whole life policy and you pay into it for 5 years, and you say, you know what, I'm tired of this, and you call them up and you just say, hey, I don't want to pay into this thing anymore, a portion of that will continue to be permanent life insurance for the rest of your life, never paying another penny in. It's called reduced paid up. Yes, Owen.
I interrupted you. No, I was trying to add another answer, but I was wrong.
Yeah, so it is permanent. It doesn't go away. It is a reduced amount of what it could have been if you had continued to pay into it, but it's still there, and it's there for your life. Yep. Okay, so let me define more what it is. This is probably a better definition than permanent life insurance. It's mutually owned, dividend paying, high cash value, whole life insurance. I know a whole lots of words there. That's the key to private equity banking. So let me break this down for you, Juliana. Mutually owned. That means there's no stockholders in the insurance company. It's just like-minded people, like you and me, contracting together for financial benefits. Does that part make sense?
Yes.
Okay, so this is like a co-op, out in a farming area where everybody puts, they build one big silo and everybody comes and throws their grain into it, all the farmers together, right? And then they all can take grain back out of it together. So this is a mutually owned company with no stockholders, just policyholders. Dividend paying. In other words, it is a for-profit organization, but here's the kicker. The money that they make, they return to us, but 99% of all of us policyholders say, well, since it's growing tax-free, I'll just let it keep growing. And so the IRS says, oh, you're just giving money back to your policyholders. Then it's a return of their premiums, and it is not a taxable event. It is tax-free. So if you think through what that means, if these companies, and all of them have been around for over 100 years, and they basically get to take all of their profits and reinvest them back into the company, and they've been doing it for 100 years without paying taxes on that, how strong and solvent is that company? Owen's shaking his head, yeah. Does that make sense? Why they're such powerful, solvent companies? That's why banks put their tier one money with them, because they don't play in the risk game like stock-based companies. High cash value. What this means, and I'm sure you've all had somebody that's pitched you whole life insurance, and now when somebody tells you they're an insurance agent, you politely tell them to go away and you turn your back on them and you walk away, right? But what's different between a typical whole life product and what I do is it's called high cash value. In a typical whole life product, 95% of the premium you pay buys death benefit, and 5% buys you cash value. In what I do, it's between 35 and 20% is between 20 and 35% is buys you the insurance, and 65 to 80% is cash value.
So what, when you say high cash value, you say 35% goes to buying the insurance?
That's correct.
How much insurance are you talking about?
As little as possible, and that's what I try to do. I try to make it as big a bank as possible, but here's the killer, Juliana. I still have to follow IRS guidelines. And so the IRS says, wait a minute here, there has to be enough insurance in this policy for us to call it an insurance policy. Because if it waddles and quacks like a savings account, then they're going to say it's a savings account and you got to pay taxes on it. If it waddles and quacks like an insurance policy, they say, oh, that's an insurance policy. So what I do is I craft something so that you get the max amount of savings account that the IRS will allow. And so when you ask how much insurance is in there, my answer is as little as possible to still follow IRS guidelines and get you the biggest savings account that I can.
And so then what would be the face value of the policy then if you die?
That's going to be very dependent on the person, but you will almost never hear me talk about face value unless, say, you've got a reason that makes you want to talk about face value. But it's more about the cash value that you've got so that you can use this as your own bank. But yes, there is a death benefit involved, and I can show you what that looks like. I could show you my policy and give you an idea. Well, let me get toward the end.
Keep going. Didn't mean to sidetrack you.
No, you're fine. But I can show you what that looks like. But yes, there is a death benefit component. Has to be there. Otherwise, the IRS would say this is just a savings account, and then it's taxable. Okay.
Right.
And then whole life, I've already explained why that is. It's what's called reduced paid up. That's where, again, you get to quit making premiums, but the policy still exists, unlike a term insurance policy. Okay. And by the way, if you've ever been somebody's told you about IULs, an IUL is a term life policy, and it ends, or you have to buy it. So, okay. So it's a perfect franchise. By the way, I've helped people all over the nation build these things for themselves. And here's the idea with this arbitrage thing is I want to have more money pushing my plane from the back than I want headwind. Remember those two different loans that we've got? I want to make sure that my loans that are pushing my plane with winds from behind are stronger than the ones in front of me. So that's the idea here, is the arbitrage to have a small headwind and a large tailwind simultaneously. All right, so there's two ways to acquire things. This is where now we can get into the mechanics instead of just the theory of how this works. So you got an opportunity cost. When, there's two ways of buying things. We save our money year after year. I want to buy a car. I put away $1,000 a month for 5 years. I pull out $30,000. I buy the car. And as soon as I buy the car, my money is gone. The opportunity cost is gone. I've got a car, but I don't have any money anymore. I traded my money for a car, and my account goes to zero. Or I go to the bank and say, well, I want the car right now. I don't want to save my money. Just give me a loan, and then I'll pay off the loan over interest. Now, here's our math problem, and I know the library in hell is filled with math problems. So here's your math story problem, folks. If your money is sitting in an account earning 4%, does it make sense to borrow money at 6.5? I want real answers here.
No, it doesn't.
Okay.
No.
Okay, Michael?
Oh, I'm sorry. Yeah, it doesn't make sense, but we do it all the time.
Okay. Well, let's walk through the math. So the car costs $30,000. I can save up my money and pay cash, or I can go borrow at 6.5% for 5 years. That's how we've been taught to do this, right? Well, as I just said, if I pay cash for that car, right? How much does that 30,000 that I just paid to buy my car with grow over the next 5 years?
It doesn't grow at all because you don't have it.
Exactly. 0. Thank you. Simple question, simple answer. Thank you. Option 2, borrowing $30,000 from the bank. So again, I've got one set of money. We just talked about this, Juliana. So here's your example of how that works. So I've got my 30,000. It's still sitting there in the bank earning 4%, and I'm going to go borrow at 6.5. So in year 1, my $30,000 is going to grow to be 31,222. Right? Because I got 4% interest on it. I'm borrowing at 6.5, so I'm making payments against that loan, and at the end of that first year, I now own 24,752. Shouldn't be a loan officer that doesn't understand both of those concepts, right? Okay, I got a couple head nods. Okay, in year 2, my 30,000 at 4% has grown to become 32,494, and what I owe on that loan is now 19,152. Year 3, my money has grown to 33,000 and I owe 13,000. Year 4, my money's grown to 35,000 and I owe 6,800. And at the end of year 5, my money has grown to 36,629 and I've paid off this loan. If you look at the amount of interest I earned 6,629. I paid 5,219. The net gain or arbitrage, $1,411. Does it make sense to borrow at 6.5 and leave my money earning 4 if I can do it?
Yes.
Yes.
Here we go. So.
Yes. Because you're borrowing from yourself.
No, you're borrowing from the insurance company. If you were borrowing from yourself, you wouldn't have that money anymore.
Not borrowing
but yes,
from
ma'am.
yourself, but you're borrowing from the insurance company.
Yes, and you are a co-owner of that insurance company. That's what's so cool. Yep. Now, I made this because literally I had a young man who had, well, 2 things happened on the same day. A young man that I got a policy for said, I want to save $30,000 to buy this truck. I was like, okay, cool. And so if he had gone out and borrowed that 30,000 right then, he would have paid about 8.5. We all understand that. The first year he would have paid about 2,300 in cumulative interest. By the time the 5 years was up, he would have paid 6,930 in interest. So that truck, instead of being 30,000, really would have cost him 36,930. Now, if he had had a private equity banking account, he'd have his $30,000 sitting there. Again, the example that I used was 4%. So at 4%, again, we saw what that money does over 5 years. It grows to 36,630, making him an extra 6,630. But he has to go borrow 30,000 from the insurance company, make those payments. So he's actually had to pay the insurance company 5,219 in interest. So the total cost of that car, you can look at it a couple different ways. But if you subtract out the 1,400, that car really cost him 28,589. But here's the important thing. At the end of 5 years, he has a car. And how much money does he have in the bank account? $36,000 and his car, right? Now, when I showed this and I showed that $1,400 difference one day, I had a guy here on this presentation go, oh, $1,400, big deal. And that bothered me. But the young man that I was doing this spreadsheet for was only 26 years old. And for him, saving $1,000 a month was a heck of a sacrifice at that age. He's not married, though, doesn't have any kids. So, he was willing to shove $1,000 a month away. And I thought to myself, but wait a minute. Does this whole process end after just 5 years if this young man's 26 years old?
No.
No. So how much would this have cost him if he really spent $30,000 in cash?
I don't know.
And I don't either, because I don't know how long he's going to live. But if he's 26, do you think he could live 10 years?
Yeah.
Yeah. And so if he had just spent cash, his cash never grew another penny, like you said, Juliana. And he, instead of having 44,000 in his bank account, he'd still be at zero with a 10-year-old car. He wouldn't have made 14,725. You think he'll live another 15 years from age 26?
Yeah.
Probably. That means that his 30,000 has now grown to 54,600, or it's made 24,000. You get the idea. That's the point.
Is that because it's still the interest is still growing?
Yes, ma'am.
And he's not putting any additional money in.
Nope.
But the compounding interest is still growing. So he got his car and he had his 36,000 still in the bank, and that 36,000 is still growing at that 4% interest?
Yes, ma'am. Yep. And I'm going to show you how he can just save for 7 years and buy cars the rest of his life and never have to do that again. So I'll show you how that works in just a second. Great observation. So how can I use this? Well, I can use it to become debt-free. I can use it to become my own bank. I can use it to finance my own things. We've already said these things. Become income tax-free and retirement tax-free. Now, the first place, and this is where I think you as loan officers can help your clients with, is to help them get debt-free. That's the first step. And why do I say that? Well, we now have 1.7 trillion in student loans, 1.5 in auto loans, 1.2 in credit card debt, 12 trillion in mortgage debt. We got lots of debt in this country. So if I could show you how to eliminate all your debt in 6 to 9 years without spending any more money, without earning any more money, would that help you?
Yes.
Loan officers, if I could show your clients how to do the same, could that help you as loan officers?
Yes.
Yeah. Or if I could teach you how to do this so that you could help your clients, would that help them and make you a better loan officer? Right.
Oh,
Yes.
yes.
And so that's the whole idea here. If any of you want to do this with me, I'll teach you how. I've gotten a number of loan officers over the years that want to do this, and I help them. If you want to just have me do it, I'll do it with your clients, whatever you want to do. But I can show you this process. We'll go into it more here in just a second. But don't think that this is just something that I only do. My whole idea is to teach you how to do this if you'd like to, so that you can help your clients more. Now, if you're not interested in doing it, that's fine. I'll still do it for your clients. But this is one of the reasons why I do this for NEXA. So why focus on debt first? Well, the average American household, of the $1,000 they earn, they spend 40% or $400 on taxes, about 23% or $230 on lifestyle. We spend about 34% on debt service. Now, I know if you're like me, you're going, nah, come on, that can't be right, because everybody that comes to me for a loan has 49% DTI. But, in theory, that's where America's at, is 34%. And then as Americans, we only save about 3%. So for every $1,000, we put $30 in the bank to save. All right. And by the way, it doesn't matter if you're a doctor or a school teacher. A doctor making $25,000 a month or a school teacher making $5,000 a month, it doesn't really matter how you spend that. Percentages still breaks out about the same. So the average American family is making about $87,000 a year times 34%, which is their debt service, comes out to $29,873. Again, loan officers, if I could show you how to get your clients back an extra $30,000 in liquidity in 6 years, would that help you get them into a better mortgage?
Yeah.
Yes.
Yeah.
Mm-hmm. Yeah, absolutely.
Yeah. And if we can get rid of their debts, what happens to their credit score?
Goes up.
Goes up.
And by the way, it was Mike Cordes that understood this, because he said to me, Eric, we kid ourselves that what we do as loan officers is not transactional. But it really is. Because the average person doesn't get a new home except every 7 years to get a new mortgage. And they forgot all about us. And we think that, well, they're never going to forget about Michael or Owen or Eric or Juliana. We're going to be the greatest thing. They're going to remember us, and they're going to put our name on a magnet on the refrigerator. And 7 years from now, they're going to call us. Yeah, right.
Right.
But he said, if you could help your clients get out of debt in 6 to 9 years, and they need a new mortgage in 7 years, and you've helped them get out of debt, do you think that they're going to use you again?
Yes.
Yeah, because we just became transformational in their lives. So here's the software that I use. Again, I can use this with you or your clients, and this is what I would do is I'd get in a Zoom environment and I would show you this tool here. And this is a real client, by the way, they told me I could use this, but they own 2 homes. They're both in the military. They've got their primary residence and then they've got a rental property. And I put down the principal, I put down the interest, I put down their monthly payments, I look at the effective interest rate. And this is something a lot of people don't understand is what that effective interest rate is. We already talked about that volume of interest a minute ago. I then take down all of their consumer debt. Again, you guys are already doing this work for me, right? I mean, you have to get this information with your clients, but we go through that. And remember I said without having to earn any more money. Most of our clients on their revolving debt, would you agree with me that even if their minimum payment's $63, they usually try to pay a little bit more?
Yes.
And
Yeah.
why is that?
Well, they're trying not to pay the interest.
Yeah, exactly. So they're trying to pay. So they're paying already a little extra. And this is where I get the money to build these accounts with, is I don't go in, Juliana, kind of to the point that you had made earlier. You said, well, how much death benefit am I going to have there? I don't know and I don't care. The reason I don't know nor care is because all I want to do is find out how much money you're not spending wisely on a monthly basis and funnel it into an account where it can grow for you and you can use it to do kind of like a snowball to get rid of your debts. Does that make sense?
Yes.
Whether you're over, like this couple here is putting in $2,289 of money that's going to be redirected into their policies. But another family might be only $400. Another family might be $1,500 a month. All I do is redirect money that's being put overpaid on debts to try to get out of debt quicker. I just refunnel that into the policy. And if that payment comes out to $450 or it comes out to $1,000, it doesn't matter to me. And yes, there's going to be a corresponding death benefit with that monthly payment, but I don't really care about how much that death benefit is. I care more about how much they're putting in on a monthly basis that's going to allow them to get out of debt. Does that better answer that question that you asked earlier, Juliana?
I think so, but I also think that people have insurance traditionally for their heirs.
Yes.
So I'm wondering, I can see how this is going to benefit them, and increase their personal assets. But what if you have clients that are using life insurance as a death benefit for their heirs?
So
Does that make sense?
yes, it does. I'll tell you about a true story. Happened this week. Gentleman got a hold. One of these guys that I work with that I'm training right now called me up and he said, "Hey, my wife and I already knew this part, but he said my wife and I just got back from Jamaica. I already knew that they had gone on vacation, and he said, hey, this couple that went with us to Jamaica, while I was sitting on the beach, this guy says, hey, I'm going to have about $210,000 within a couple weeks here, and I want to go buy some more real estate, but is there a better way than just paying all my cash and making my cash go away?" And so they got on the phone with me, and the guy's 73 years old. How much is insurance going to cost a 73-year-old man?
Oh, about $500 a month.
Yeah, it's going to be more than that. But yeah, it's not going to be
Yeah, it's not going to be cheap.
It's not going to be cheap. Yeah, not at all. And so I said to him, why don't we do this? When I started talking with him, see, I asked questions about his finances, not about his death benefit, Juliana. And he said, well, here's what I do right now. He says, my brother and I own a warehouse, and I make about $33,000 a month off of that warehouse from the rent. And so if you multiply 33,000 times 12, that tells you what his annual income is. And he said, but I've got 7 kids. And so what I do at the end of the year is I give each child $30,000. That's why he was going to have $210,000, because that $30,000, he puts it in the bank every month, and then at the end of the year, he pulls out $30,000 for Christmas, and he gives each of his kids $30,000, and then they have to pay the tax on that $30,000, and it lowers his tax basis. That's what he's been doing for years. And I said, well, why don't we do this instead? We're going to build you a family trust. The trust is going to own the policies on all 7 of your kids. And instead of taking out the policy on you, sir, we'll take out a policy on each of your children. And beneficiaries will be your grandchildren. And then we'll put that warehouse, the half that you own, into the trust. The trust will own it. And so all those payments will now come into the trust. The trust will then pay these insurance policies for all of your kids. And when you pass away, yeah, your kids aren't going to get any money immediately, but they still get that building that's throwing $30,000, $33,000 a month toward them, which is buying insurance policies that your kids can go borrow from if they really need some money right now. But better than that, now as each of your kids begin to pass away, now you've got all that tax-free death benefit coming back into the trust that builds a huge nest egg that you can redo that again for your grandkids. And now you've built tax-free generational wealth for generations to come. And he went, oh my heavens.
Hey, Eric, can I ask you a question?
Yes, sir.
Great, great. So if I were to own an ice cream shop that's an LLC, totally off base, okay? I own an ice cream shop that's an LLC. Can I take the funds pre-tax from the LLC, place this into a cash accumulation account through private equity banking, and then utilize this system which you're describing? Would I be able to do that? Or within a business, are these not tax-free investments?
So the straight up answer is no.
Okay.
But because it's post-tax dollars that you put into this so that the death benefit is also tax-free. Having said that, Owen, if I can go on with that example, and I wasn't going to, but because you brought that question up, what we're really going to do is each of the kids is going to have an LLC. They're going to give the money to the kids or to the parents. The parents of this elderly man, they're going to give each of the parents that money, and then the parents are going to hire their children to work for their companies, and the kids that are under 18 years old are going to be able to get I think it was 17,000 or 30. Again, I was on the call, but I'm not the CPA or the attorney. So what I did is I got him involved with a team that I've got with an attorney and a CPA, and the CPA explained how he could structure that so that entire $210,000 is tax-free because they're moving it into other organizations and then hiring kids to do it. So is there a way to do it? Yes, probably. But from a strictly insurance standpoint, Owen, no. From a business organizational structure standpoint, the answer would probably be yes. But that would be a specific question that you and I and the CPA and the attorneys that I use could help you answer.
In the last 3 years, I've learned to financial map, just like I'm mapping an electrical system when I'm designing something. I financially map one step after another and just putting all the pieces together. So thank you.
And that's what we just did for that gentleman yesterday. He was blown away. Yeah,
absolutely.
Yeah, in fact, the conversation started Friday, and then yesterday is when we met with the CPA and the attorney, and now we're in the middle of structuring that stuff for him. So, yeah, to answer your question, yeah, he will be able to move $210,000 from now on into this environment, make it tax-free, and not pay anything on it. But it's not the insurance that allows him to do that; it's the business structure.
Right. And in a matter of speaking, would I be able to set up an ice cream shop and then put funds into the cash accumulation account and then draw funds from the general fund?
Yes, you can.
Would the initial basis being invested, would that be tax-free?
If you've paid tax on it, then yes.
Okay. Gotcha.
Because, again, you don't have to, but if you don't, when the death benefit comes out, you're going to pay taxes on that. So do you really want your wife and heirs or business partners at the ice cream shop to have to pay tax on $2 million lump sum, or would you rather have them get it tax-free?
I understand. Yep.
Yeah. So
just like a 401k, I guess. Maybe like a 401k. Yeah.
In that, yeah, but if you pay the tax up front, but again, there's also strategies to help you not have to do that, because now you can write off all those expenses at the ice cream shop too.
Right. Absolutely. Absolutely.
Yep. Great questions. Thank you. Yeah, not a problem. So you see how I structure this with people. Did that answer those questions for both of you?
Oh, yeah.
Okay, good. Okay, so then I go in and I look at these people's investments, blah, blah, blah. And I include their insurance. So they already had some insurance. They're both in the military, so they've got TSP. TSP is military speak for 401k. That's their qualified plan. Again, I don't need to explain all of their expenses. Then I go into their wages and how much they're making. Boom, boom, boom. Their rental property, etc. And then I look at, That was their TSP earlier. Now I look at their insurance policies. And then what I go and do is I build a report that shows what they can do. And again, Juliana, to hit home that point, it has nothing to do with death benefit. It has everything to do with how much money we can redirect that they should be moving into this account. And so if they were to follow their current plan, as you can see, they'll be in debt for 29 years and 10 months. And the red part is principal. So they're going to end up spending $325,000 in interest over the next 29 years. With this plan, we're going to accelerate that to 9 years and 8 months. As I said earlier, it's usually 6 to 9 years, but because they own two real estate mortgages, then it's just a little bit longer. But that gives you an idea of what I can do for almost anybody, get them out of debt in 9 years. Now, loan officers, let me ask you this, and I know I've already asked this question once, but I'm going to ask it again. If I gave you this report to give to one of your clients and you saw, and this was a real report back when I did it, and it still is, if you saw that Mariah and Matthew could pay off their first credit card on August 24th, what are you going to do on August 24th?
You're going to call them and congratulate them.
Yes, ma'am. And what's that going to do? Put you right back on top of their mindset, right? They're going to pay off that loan.
Going.
Yep. And then the next month, you got it. Now, what happens, loan officers, once they've paid off all 3 credit cards and their car in 1 year, and all they have left is a solar loan and 2 home loans? What's happened to their credit score?
It might increase.
Yeah.
Increased.
Yeah, it's probably increased. And if they were ready to move into a new home, they're in the military. It's been 2 years. You think they got to move again? Yep, they're going from Fort Hood to Fort Bliss. You think they're going to let you help them get that new loan wherever they get transferred to next?
Yes.
Yeah. So that's the whole point of being involved in this as loan officers. So I would give you a copy of this report too, so that you could be touching base with your clients. Now, obviously, the world is not static, right? You're not going to call 4 months from now and go, hey, you can pay that off, because what are they going to tell you? Oh, well, Christmas came around and we had to put another $1,000 on that credit card. All right, fine. But they got a plan and they can work toward it, and you're there to help them along the way, right?
Mm-hmm.
So anyhow, so this couple is going to save $200,000 in interest by doing this plan. All right. And so I often get asked the question, well, how much do you have to put into one of these things? I've done these for people as low as $100 a month and as high as over $100,000 a month. I've had people drop in as little as $100 down and over $1 million in one fell swoop. Okay. So you can build it any way you want. So here's a real world example. Back to that 26-year-old. And this is the one I was telling you about. Wow, I've gone over time. I apologize. If you guys need me to quit, I'll quit.
No,
you're fine.
Okay, so
Yeah.
okay, so no, if you guys are still excited about this, let's keep going. So, what are the financial goals? This is where I go with people, Juliana. I never ask them, what's your death thing? Your typical insurance agent's going to go, well, gee, what happens tonight, Owen, if Papa San doesn't make it home and Mama San and the kids are left with the mortgage, in that tone of voice like, oh, crap. That's how they sell you insurance. I don't do that. I talk about your financial goals. I'm going to get excited about your ice cream shop and understand what you're trying to accomplish with your ice cream shop. And we're going to craft a financial tool for your ice cream shop, not, oh, what happens if Owen doesn't make it home tonight and Mama San's left with the kids?
I want to pay less taxes.
Okay. And so, again, if that's your goal, that's what we go craft for you, Juliana. That's what I'm trying to say for folks. Thank you. So, yeah. So this young man wanted it. Now, here's this real policy for that kid. He was 26 years old. So when it says age on an insurance policy, it's talking about the end of the next year. So it's 1 year later. So the kid's 26. I shouldn't call him a kid. That may sound condescending, but the young man is 26 years old. I got white hair. I'm getting up there. He's a kid. Anyhow, 26 years old. He's going to put in $1,000 a month. And he told me that at 30, he wanted $30,000. So he said, I'm going to put in $1,000 a month. You'll note here that he has 2 options. He can save for 30 months and then pay cash and lose his opportunity cost, or he can pay $1,000 a month for 36 months and then borrow back the $30,000. And so here's what the cost is. This is his real cost. He's putting in 1,000, but only 360 of it is buying insurance. The other 640 is buying him savings account. And because that's growing tax-free and compounded interest, it's going to surpass it. So let's look at this, by the way. You'll notice that in year 3, he puts 12,000 in, but how much does his account grow by?
12,326.
Right. So this isn't a short-term play, but if you take it out at least 3 years, at that point, the insurance is earning more money in interest than it's costing you, and it's basically a free policy the rest of your life. But what I did here is I just stopped his payments at 7 years. Because, by the way, back to what I was talking about with the IRS wants to see policy payments at least for 7 years. If you pull out before that, they might call it a MEC, a modified endowment, and any of your gains in here might be taxable. So that's why I did it for 7 years, so it was that minimum. Okay? So 7 years, 84 months at $360 a month is about $30,000. All right, 7 payments, 7 years, total premiums. His savings is $84,000. So he's put in $84,000. He's got $85,000 there available after 10 years, right? And that's, if he quit right then, he'd still have $85,000. All right. So at year 12, though, he's still only put in $84,000. And how much is his cash value worth?
84,000.
No, he's put in $84,000 in premiums. His cash value is now worth right there.
106,000.
106,000. Yeah, almost 107,000. So
I can't see the bottom of your screen.
I'm sorry. Okay.
No, that's okay. That's okay.
Now, earlier I gave an example of putting it in at 4 and borrowing it back at 6.5. The reality is this company that I'm working with right now, you're getting paid 5.2 and you can borrow back at 5. Yeah, that's pretty cool, huh? So let's see what happens here. So after 3 years, this young man has 30,000 in there. He wants to go borrow that. Now, here's what I try to teach people is how to be an honest banker. This is why it's called private equity banking. So I throw in here the traditional market rate for a $30,000 loan. For a car, I put 8.5%. Are you guys okay with that being a rate that's about right for a car? Okay.
Yeah,
and so we saw what happens to his money growing at 5.2%. It grows to 31, then 33, then 35, then 36, then 38,000. So his money will have grown by $8,886 within 5 years. Everybody's with me on that, right? But he's going to pay down this loan as though it's a structured loan to the insurance company. So the first year he'll pay it down to 24, then 19, then 13. And the payments that he'll need to make at 8.5%, if it was a traditional loan, and it is not, but if it was a traditional loan, he would need to be making payments of $634 a month. Everybody with me on that? Right? Or $7,613. But his real rate is only 5. So he's really only having to pay back the principal because there's a difference. And so if he wants to pay off $30,000 over 5 years, he has to pay $6,000 a year or $500 a month, earning him an extra $1,613 a year. Here's the question. If you add all that up, if you take the amount that this grew by and he were an honest banker with himself, where does he put this $1,613 every year?
In his savings.
In his insurance policy savings account. Exactly. So who's earning that interest?
He is.
He is.
He is. So he's actually put an extra $16,951. That's what I mean by the tailwind. Again, if the APR is 8.5, the effective interest rate in year 1 is really 36%. The effective interest rate in year 3 is 16, and it doesn't go below 8% until year 5. And what's his tailwind? Just the utility of the car. But the way we do it, he's got 0 headwind, and his cost of borrowing money is 5%. But the market rate's 8.5, which he's paying back. So who makes the difference? You've already answered that. He does. What's the ROI between 5 and 8.5?
Very good.
That's right. If you said 3.5, we'd both be wrong. It isn't. If we go look at an ROI calculator, and I went out to calculator.net, put in $5, have it grow to 8.5 in 1 year, right? The investment gain is $3.50, but the ROI is
70%.
70%.
Wow. Wow.
That's what private equity banking does for you. It allows you to become your own bank.
Wow.
Yeah. My wife and I just did this for our daughter. She was living in a home in the same city we're in, and my neighbor was having a yard sale, and I overheard him say to somebody that came to the yard sale that he and his wife were putting their house up for sale on Monday. They were in the military, and they were getting out of the military, and they were just going to get an RV and travel in retirement. And so as soon as that guy left, I walked over to my neighbor and said, "Hey, Jason, you're both military. Did you get a VA loan?" And he goes, "Yeah." And I said, "So it's assumable." I can tell this story to you guys because you're all loan officers and understand it, right? And I said, "Well, it's assumable." He goes, "I don't know." And I said, "Yeah, well, if it's a VA, it's assumable." I said, "How much do you owe on the home?" It was right near 300,000. I said, "How much are you trying to sell it for?" He said, 345. I said, "So do you have a real estate agent involved?" He goes, "No, but we were going to call one on Monday." And so I said, "Well, if you pay a real estate agent, that's about another $26,000. So you're really only trying to pull about 21,000 out of this thing, right?" He said, "Yeah." I said, "If Diane and I give you $21,000, would you allow our kids to assume your VA loan?" I said, "How long have you owned the house?" He goes, "Oh, we got here about 6 months before you guys did." I said, "Then you're down in the mid twos." He said, "Exactly." So Diane and I borrowed $20,000. Well, we borrowed 30 because the kids wanted to buy their refrigerator and their washer and dryer and stuff like that, and they were selling it because they didn't need it anymore because they were going to get an RV. Anyhow, so we loaned our kids $30,000. What would be a fair rate for me to offer to my kids in today's market? 30,000 as a bridge loan while they sell their house?
Friends and family discount or what the banks are charging?
No, friends and family. I mean, it's my kids.
I'd say 6%.
5% interest rate.
Yeah, well, we went halfway between that. We went 5.5. So it's only going to be a bridge loan for 3 months, right? But what's my cost on that money? So I just became a bank for my family. Does that make sense? And I've allowed my kids to buy the next door neighbor's house because I had the money available. I just pulled it out. And as soon as they sell their house, they're giving us back our 30,000 because they have 64,000 in equity. In theory, they still have to sell it and clear all that money, but you get the idea. So I've now become my family's bank. Anyhow, all right. So that ROI is 70%. And that's what I teach people how to do is take that money and put it back into their own pockets. Now, back to this young man. After 5 years, how much money does he have available in that account? And I already asked that question earlier. So at year 8, he never makes another payment into his premium. How much cash value does he have?
89,000.
89,000. And so what I'm going to say is that he's going to trade in his old car and now he's going to buy a car for 80,000. Fair enough?
Okay.
And I'm going to say that he's paying it over 5 years at 7.5% because I don't know what interest was going to go to in 5 years. Okay. So now he does the same game again. Now he makes payments to himself. He borrows the money from himself, not the bank. He makes the payments back to himself. And now he's actually making extra payments. Instead of paying 19,000 a year, he's only needing to pay 16. So the difference there is 3,773. He's taking that plus the money that's still growing in there without taking it out. He's putting all of that together back into his policy. So that's $42,000 over 5 years. You get the picture? He just financed his next car. He only saved money once, right? Again, bore you on it, but there we go at year 13. Now how much money after he's paid off his second car?
115,000.
115. Goes through the same thing, borrows 100,000. You guys are getting the idea. I don't have to bore you with all this stuff, but basically what I've got is this guy's going to buy 5 new cars throughout his life. Do you think that's a over exaggeration?
No.
Nah.
Yeah.
And he only saved up his money once. And at the end of that gig, he put in 84,000 for 7 years. He has 3 30 years, he has 5 cars, and he still has $223,000 in his savings account. How's that for a new paradigm on how to buy things?
Interesting.
So, Eric, just to hear what you're saying, having this cash equity account, having this account, this strategy really helps us reduce on, borrowing funds from other sources for vehicles. It's one strategy for vehicles, buying an airplane on credit, buying a yacht or the jet skis. Just joking, or even a home.
It doesn't matter. You can take it to go on a vacation. Again,
Right.
when in fact I did this and I don't think Mike Neal would care that I say this because I know he's told me he'll give me a testimonial on this. But Mike Neal put in a chunk of money, and then a couple days later said, "Hey, Eric, I'm taking the kids to Hawaii. I want to borrow some of that back." He goes, "How long does the application process take?" I said, "Mike, there is no application process. We just go online, we fill out the form, you request the money, and they wire it back into your account." No, unfortunately, in his case, they didn't catch that note, and they ended up mailing him the check instead of just wiring it into his account. But it would have been there in about 3 days if we had just asked, if I had done my job right and made sure I clicked the box that said wire it. But there's no application. They don't care if you're using that money to go on a trip to Hawaii, or you're buying a jet ski, or you're building a new business.
And Eric, another question for you: Can we utilize the debt in this fund, or the type of debt that's in this fund, to leverage it as warehouse line of credit? If we came up with $1 trillion,
that's exactly what it is.
Okay, and could we utilize this for financing, to offer financing for other people's homes?
You can.
No, that's on a grander scale, but I mean,
yes,
somebody would be paying this fund interest every month and the payment,
right.
Not a mortgage, but only we're doing 5 or 6, not
right. So if you want to become a hard money lender, like I said, I just did it for my daughter. Do you think my insurance company asked me who I was going to give that $30,000 to when I asked for it?
No.
No, they didn't. So they didn't care that I gave it to my daughter or that I wasted it on a vacation over the summer.
Sure.
It's my money.
Quick question.
Yes, ma'am.
Can someone else do the payment?
Yes. So, like I said, in the case of that elderly gentleman that I was just talking about, it's going to be his grandkids that end up making the payments on policies on their parents. But he's still going to be the owner because he's going to be the owner of the trust, and he'll still have access to all the cash value, and he plans on pulling it out to buy another property. Because that's how he's made his money, is owning warehouses and owning commercial property. So he wants to start shoving that money into a policy where he can start borrowing money back out. So that's a great question, Gada. There are 3 components to an insurance policy. One is the owner of the policy. They make the payments and they have access to all the cash value. The next one is the body that's being insured. In this case, because that elderly gentleman is old enough that it doesn't make sense to insure him, we're insuring his 7 kids, and they're between ages 35 and 45, no, 50. And I think his oldest is 53 and his youngest is 35. And then the other one is the beneficiaries. And so in this case, both the trust is going to be the owner, the bodies are going to be the 7 kids, and the beneficiaries are going to also be the trust. And then the members of the trust will be his family and his kids. So we can get as elaborate as we want on that, Gada, to create these policies. Does that answer your question?
Absolutely. Thank you.
Mm-hmm. I have a question.
Sure.
At the end of the year, like if you're filing your taxes or anything like that, do you have to supply any documentation to the IRS, what you did with your account or anything like that?
No, ma'am, because everything inside of there is tax-free. And if I've built it properly, it will never become a taxable entity for you.
Is there a conflict of interest between being an MLO, being an LO? Okay.
Nope.
Okay.
In fact, remember, Mike asked me to do this knowing I'm an LO. Yep.
Okay, that's right.
No conflict of interest. Now, you asked a question earlier that I kind of want to hit on. So one more thing, and then I'll wrap this up because I know we've gone way over. These guys are real estate investors. They just bought they just sold a home, and they've got 200,000 in their pockets. And so what this guy said is, well, I'll put 100,000 into mine. He's also putting $100,000 into his wife's policy. I won't go into details on that, but let me come over to the retirement area. So they're going to put money into this thing. And I said, okay, well, how much do you want to pull out at retirement? Well, they will have put in they're going to take the money from their rental properties. He's an attorney, so he makes money in other places. He's going to take his rental income right now, which is $36,000 a year, and shove it into this because he doesn't need that money to live on. So that's really what they're doing. So they're going to have $1.6 million that they will have put in by age 70. And then they're going to be able to pull out $220,000 toward retirement until he's 121 years old. It'll never go away. Here's how it works. In the first year, he borrows $220,000. He's going to have $2,600,000 sitting there earning interest at 5.2%. So his interest that year is going to be $123,000. He's going to pay interest on the 220 that he borrows. Well, that's 11 grand. The next year, he's going to pull another 220. And he's going to pay $22,000 on that, but his pot of money is still growing. And so if we go look at this like at, say, age 90, he'll still have $568,000 in cash value. He'll have borrowed $4.6 million. Isn't that cool? He put in 1.6 and he will have borrowed 4.6 back. His cash value will be earning 189. He'll be paying interest of 231. So it is eating away at it finally. But if he were to die that year at age 90, or if both of them died at age 90, their combined death benefit would be worth $6 million. The insurance company is going to pay back the loan that he took from them of $4.6 million, and he's still going to have $1.5 million to give to his family as an inheritance. You had asked that question earlier, Juliana, and I wanted to show you that. That's why I made sure you saw that, because you had asked the question earlier and it wasn't the right time and place to explain it. But that's what people can do. So this is not only great during life when you want to finance your life, but it's also great when you want to start retiring and pulling out. So let me go back and ask a couple questions here. After they're no longer, when it's RPU'd, how much are they actually paying in policy, premiums, taxes, and fees?
Zero.
If it were term life, which is what we began this conversation with, Julian, what would they have to be paying at age 70 to get term insurance of $5 million?
A lot. They wouldn't be qualified for it.
Exactly.
And some term policies, the premium can triple or quadruple at a certain age.
Right. Yeah. Let's go look at it at age 90. How much did he pay in premiums that year to get $6 million worth of insurance? Nothing. Zero. He hasn't made a payment. Yeah. And so that's why I use only whole life, because of the reduced paid up ability that whole life has that term life does not. I've probably broken all the blood vessels in your brains today. I really apologize for going long, but you guys have asked so many great questions. Is there anything else?
Eric, real quick.
Yes.
Don't want to many people's times, everyone's time. So if I were to dump funds, 20 grand I'm going to get in a commission in the next year. Okay. I would have dumped 20 grand into my Wells Fargo bank account.
Yep.
The FDIC insured up to 500 grand or something, right?
Right.
If I were to dump that 20 grand into US Treasury bonds or something,
yep,
there's a security guarantee that it's secured.
Yep.
Like 2008 plus 2023 could happen all the same time, and my Treasury bond would be secure.
Yep.
I'm curious what the investment risk is, or is this secured by the government somehow that says your money is secured?
Not. It is secured by the fact that these companies are super, super conservative, and that's where banks put their money. They have never had 1 year since they started that they didn't pay dividends, because they do not invest in anything risky. Where they put this money is things like my wife and I's old city where we lived. They needed to throw in fiber optics, so they got the loan from an insurance company, but that was a bond that we as the taxpayers were willing to sign. So they had a note that was backed by a bond and being paid by taxpayers. That's the kind of things that insurance companies invest in. They don't do anything speculative. But no,
Okay.
there is no but you're a co-owner. Remember, as a co-owner, the fiduciary responsibility of the CEO and all the executives in an insurance company is to whom?
It's to the shareholders.
There are no shareholders.
Okay. Got it. But I'm not sure.
To the policy holders.
Policyholders, okay.
And that's probably what you were thinking when you said shareholders, but it's the policy holders. But there is a huge difference, right?
Yeah. And how many policyholders are there in the team and within the group, the network?
Oh, jeez.
Just curious, like
these companies are worth many, many billions of dollars, the ones that I work with. They're the most sound financial organizations in America. Yeah.
And if we're to invest in like a cash accumulation account you were talking about, that's what it's called, right?
Yes, cash accumulation account.
I only know Mortgage 101, and I know how to read Forbes or Motley Fool.
Yeah.
If I were to invest in a cash accumulation account, what would be the time period between the time I invest and the time I can draw for the first day, first month, first year, first decade?
So the first time you do it, like I said, Mike Neal asked for that. And it was like 3 days after he had submitted the money and he was requesting it back.
So there's like no MEC. You were talking about that MEC or something?
No, the MEC deals with how I structure the policy in the first place, and my software warns me if it's a MEC. So that's when I'm busy crafting it behind the scenes when you're not watching me. You give me the parameters, and I go out and I throw it into a software program that the insurance company provides me. And if I try to get too aggressive, I get a pop-up window that says, this has just become a MEC. You're going to have to tell your client it's a MEC. So I go back and remodify it so it isn't a MEC. So that's my job, is to make sure that it's not a MEC.
Okay. Right. Thanks for answering my questions. Where can I find out more?
So I've got my email address. That's my company address up there on the thing. I put my email address for NEXA in there. Send me over an email, and we will find a time where we can get on a Zoom call together, and I'll walk through with each of you, put together an illustration that doesn't cost you a nickel. We just do it together, and that'll give you a real idea as to what your finances could do in this type of an environment.
Victory. Okay, and Eric, your phone number, just to confirm, is 254-408-2111.
That is correct, Juliana.
Awesome. Thank you so much.
Oh, thanks for coming back, ma'am. Was it better this time?
Oh, it was 100% better.
Oh, good.
Than last month. I get it. I remember there was a lady last time who said it took her a few times before she got it too.
Oh, and her policy's done now. Her name's Christina. She just got hers Friday. Yeah, that was Christina.
But this flowed way better than the last time. And so I so appreciate it. So I'm going to start my plan, because I got to call you and you got to set me up, because it gave a lot of clarity the second time around.
Well,
and I get it. I know,
Well, I'm sorry it's such a complicated issue that it takes twice to get it. But, if you go to my website, Private Equity Banking, you scroll down to like the third video, I explain this after 5 years of working with this guy who has a master's degree in finance and he's an attorney. I explain his numbers to him. He goes, oh my gosh, Eric, this finally makes sense. I've been doing this for 7 years, and I'm just barely, after 7 years, I think, learning how to explain it properly so that people go, oh, light bulb goes off. It makes sense.
Yeah, that's what happened. Now, the last thing I have is, those numbers that you show us. So do we have statements online that we can monitor the results?
All of it.
Savings.
Yes, ma'am. You go in and look at, in fact, if I had time, I could show you mine, but
No,
mine, if you look at my illustration, it says I should have
it.
200,000 and I've really got 219,000 because I've been using it as a bank.
Thank you.
Thank you, guys. Thank you, Eric.
Merry Christmas to all of you. If I don't hear from you before then, but please reach out to me and let's do something.
Okay, Merry Christmas.
Merry Christmas.
Thank you. Appreciate it.
Oh, not a problem, Michael. Thanks for your
All right,
input.
Michael, Merry Christmas.
We'll see you guys.